Welcome to the Fresh Start Podcast, where we discuss debt management and financial wellness. Here are your hosts, Lionel and Stacy.
Hello everyone, welcome to Fresh Start. My name is Lionel and she is Stacy. So today's episode is about credit. So in a nutshell, Stacy, what is credit?
Credit is the ability of a consumer to get goods or services prior to payment based on trust that they will pay in the future. And in other words, your word is your bond.
Okay, so a lot of people seem to confuse debt and credit. So what's the difference?
Well, look at it as a before and after story. In terms of credit is the ability to borrow money, while credit is the result of borrowing that money.
I mean debt.
Or debt is the result of borrowing that money.
Got you. All right. So the benefit, I guess, of having credit, good or bad, is that you have a score. And there are multiple scoring models out there, but the two most popular ones are FICO and Vantage. So I'm going to go a little bit into each one to kind of tell you what the differences are. So a FICO score is used by a lot of vendors, and everybody wants to have good credit. So exactly what is good credit according to FICO? FICO is saying that anybody with a score of between 670 to 739 has quote unquote good credit. Of course, because it's on a spectrum,
Right.
the people at 670 are going to get loans with higher interest rates than the people at 739. So anywhere in between those two numbers is considered good credit. Now for FICO, a better or very good credit is anything between 740 and 799. So about 18% of the population of the United States right now falls between those numbers. Now, exceptional credit is anything 800 and above. And to be honest with you, anybody with an 800 to 850 in terms of debts, they're going to get the best credit card rates,
Right.
They're going to get the best loan rates, et cetera, et cetera. But the difference in between what a person with an 850 credit score and a person with an 800 credit score gets in terms of a interest rate is very negligible.
Right.
Low.
The rate could only be so low.
So FICO weighs their score like this, the things they look for to come up with the score. So your payment history is about 35% of your score. The amount that you owe is about 30% of your score. The length of your credit history is very important. That's 15% of your score. How much new credit you've gotten in the last year, that's about 10%. And your mix of the types of credit you have, automobile, mortgage, credit card loans, et cetera, that's another 10%. So those are what the things that are looked at to come up with that score.
Right.
So what about the Vantage?
And as I was saying, the two major scoring models are FICO and Vantage. And Vantage is a relatively new credit scoring model. FICO has had a monopoly on credit scoring since credit scoring began. So monopolies are never good. So it's always good to have someone else in the market to kind of offset and kind of force the other party to make sure that basically they're taking into account all of the new types of credit.
Right.
And I think Vantage tries to do that because there are so many people who don't have what's called traditional credit.
Okay.
And traditional credit being mortgages, car loans, perhaps bank loans. A lot of people choose to pay cash for a vehicle, so they won't have a car loan. They may be renting, so they won't have a mortgage. They may choose not to borrow from banks and pay cash for whatever they want to purchase. That does not mean those people aren't creditworthy.
Right.
And banks, of course, want to loan money, and they want to loan money to people who are creditworthy. So they need a way to find those people who don't fit into that traditional scoring model.
So what did they change in
So
Vantage?
Vantage kind of weighs those same criteria that Lionel listed. Vantage kind of weighs those differently. And Vantage has also added different types of debt or different types of creditors to be included in your credit score. Okay. And I know a lot of you have probably heard about the Experian Boost,
right?
And that is what they're trying to factor in, because Experian Boost allows for rental payments to be calculated in. It allows for utility payments, phone bills, all of those types of debts to be factored in to determine whether or not you're creditworthy. And for some people, that's a good thing. Okay. You're paying those things on time.
Right. So let's talk about the bad credit.
Yeah.
What's considered bad credit?
Well, bad credit in terms of
loans, in either credit cards, loans, or financing cars. So let's talk about subprime.
Well, bad credit means basically that a lender's not really willing to loan to you on based on prime rates.
Okay.
They still want to make money, because that's always what a bank is interested in doing. But because you may be more of a risk, a bank may say, well, I'll loan you money. It's just going to cost you more to get it.
Gotcha.
And bad credit costs you a whole lot more. The bank says a little more, but in reality, it's a lot more. A lot more than it would cost someone who has prime credit.
All right. So what are some of the examples? You say bad credit will get the worst rates. You have extra fees, because
absolutely.
I've seen,
you end up with origination fees. Right. You end up with in terms of insurances that they make you pay in case you don't follow through. You have to take out insurance along with that loan. They also have maintenance fees that are associated with it. I know some of you may have credit cards that have a $7 monthly maintenance fee, whether you carry a balance or not. They're all ridiculous. Service fees, a variety of different fees. And essentially, they know you don't have any other options, so you're not going to say no. You really have no buying power, so you're kind of stuck with it.
Right. So the number one entity that deals with subprime credit, or quote unquote bad credit, which is subprime credit, are auto companies. So you go out there, and auto companies are number one. Payday loan companies are second, because they're always in the mix. So let's talk about autos for a minute. So instead of when you have bad credit or subprime credit, you're not generally financed directly by the bank,
right,
or like a GMAC or Ford financing, et cetera, because they don't want to deal with you. That's where the subprime finance companies come into play that would agree to write that loan. And of course, that loan is costing you major money. So for instance, one bank has loaned, I think, $81 billion to different subprime companies, because that's where the money is really made. So let me give you an example of what two customers might pay for a vehicle based on their credit score. So here's the example. We have two people looking to buy a car. The car is $18,000 to be paid out over 5 years. So the first person has a credit score over 700. The interest rate they get for that loan is 3%. So their payment calculates for a 5-year loan at 3%. It calculates to about $326 a month. So that's person number one. Person number two comes to buy the same exact vehicle, $18,000, but their credit score is 600 or less.
Right.
That person has an interest rate of 15%.
Which is not unusual. Interest rates for vehicles can be high as 23, 24%.
Right. But for this example,
15%
they're doing pretty well. So let's say we have them at 15% for that $18,000 vehicle. So guess what? Their payment is going to be $427 a month. Same vehicle, same length of time, but they're paying $101 difference a month for that vehicle. So let's spread that out over the 5 years or 60 months. So the person with good credit ends up paying, quote unquote, good credit, let me say that. Better credit, person who is 700 and above, they're paying $1,500 in interest on that loan. So their total payment for that loan is $19,500.
And interest at that amount over 5 years, that's pretty good.
That's pretty good.
That's pretty good.
So let's look at person number 2, who was paying 15% over 5 years. Their interest payment is $7,000. And if you look at that $18,000 vehicle, by the time they're done paying for it in 5 years, they've paid $25,000. So look at that difference. As you can see, the finance companies, they thrive on wanting you to walk through the door with bad credit or subprime credit, because they know that's where they're going to make the most money. And think about it this way. They charge you 15% for the loan, but when they borrow their money, they borrow the money at 3% from the bank, the subprime company, or less. But let's just say 3%, but you're right, or less. So they borrow that money at that percentage rate. So they're making 12% on their return of investment on you by taking that risk. So it's very, very important for you to try to do something about that. So what are some of the ways, Stacey, that bad credit affects you?
And when we think about credit, we think about purchases for the most part, a mortgage, loans, vehicles. But your credit score follows you everywhere throughout your life. For example, if you're looking to rent, let's just say you're looking to rent an apartment.
Right.
Your credit score will factor in. And a creditor looks at your score, your history, if you've had other evictions perhaps, if you had other issues with renting.
Late payments, as such.
They take all of that into account as to whether or not they want to take a risk in renting to you. And if they decide to rent to you, it could be at a premium.
Right, with a higher
Person
deposit.
with great credit may have a $500 deposit. You may have a $1,500 deposit.
Got you.
So again, it's costing you. It's another way is employment. And this one is really big, and especially now, because right now it's an employer's market. Right. Employers can choose from the cream of the crop. You can have the best resume out of the stack. Right. And they take a look at your credit score and credit report and think, do we want to take a risk?
Right.
Is it worth it to take the risk when we got another good candidate right here whose credit score is great?
Right, because if they hire you and you have one of those jobs that you have to travel, maybe go around, you're going to have a company credit card, they're looking at your trustworthiness or credit worthiness in order to decide, even though they shouldn't factor that in.
Right, let's be honest.
The truth is, nobody wants to deal with that.
They do. In addition to that, you may have a job that may require you to handle finances for the company, and they again don't want to take the risk, either from a legal perspective or just not wanting to deal with it because there are other candidates who can satisfy their requirements with credit that's considered good.
Right.
Also, some jobs require that you have a certain level of clearance. Some creditors or some jobs may think that you could be compromised. So there are a lot of reasons, and a lot of valid ones, that an employer may say, let's just not take the risk.
But let's look at even insurance.
And that was what I was just going to get to. Insurance, I think, is the biggest one. And the one that kind of surprises people the most, I think, and they don't even realize that is a factor. Insurance rates are so heavily based on credit. You can have two people in the same zip code, same age, same sex, and the rate is based on credit, and the amount that person is paying is ridiculous in comparison to someone with good credit. Right.
And most times we don't we never stop to add up the actual cost.
The cost is cumulative, but it is on a monthly basis. You could be shelling out hundreds of dollars extra just because of your credit score.
So we're talking about, let's go back to my example, $7,000 on a $18,000 loan.
$7,000 versus $1,500.
Right, but
big difference.
But let's look at, imagine what it is for a house purchase where you're buying
over 30 years.
You're buying over 30 years on a $200,000 house. Yeah. So you're probably paying $50,000 more
at least
than the person.
More than that.
That is insane.
Over 30 years is probably more than that.
So here's the deal, though. Even though we've described all these different scenarios, it's not too late to be able to fix this situation. Yes, your credit may be subprime right now or not where you want it, or even, you're trying to get it to a certain level to, make certain types of purchases. So if your credit score is keeping you from moving forward in the things that you want to do, definitely come and see us because we can help.
And there may be some quick fixes for some people to kind of repair and get their credit to where they want it to be. But for some people, it may not be that simple. Right. And that's why we encourage you to please come see us. We have 3 locations in the Metro Atlanta area. I'm sure one of those locations will be convenient for you. Come see us for a consultation. Consultations are always free, no cost to you other than a little bit of your time.
Thank you everyone for listening, and we'll see you next week.